welcome to Global Mantra, the show that brings to you prominent fund managers from the City of London and gets their views on the global market situation. Joining me on the show right now is Masha, the head of emerging market equities at PIMCO. Masha, it's so good to have you on the show. Thanks very much for taking out the time.
Thank you.
Do you think that right now what we're witnessing in Europe is just a lull before the storm, or do you think the worst has been behind us?
Well, it's tough to make a conclusive statement. Akin to your last statement. However, if you were to look at what changed over the past 6 weeks, I would say that the taps of liquidity that people talked so much about in the fourth quarter of last year, i.e. ECB going all in, Fed doing QE, some of that actually has happened. So Fed has done what Bill Gross has dubbed as QE 2.5, and clearly in Europe we have seen ECB doing LTRO operations, which have eased the worries about the accident happening. So I think that markets are reacting perhaps to the situation of the seizure of the market not being the central scenario, but being a left tail risk where probability has diminished. And clearly there is value. So we are seeing perhaps some of that being realized in the market.
How would you characterize then the rally that we're seeing in emerging markets right now?
Well, there's a number of things. It's never one single thing, although you can say it's a risk-on trade that is taking place. But if you were to look at the most pro-cyclical sectors in EM, like steels, those trade not that far off from replacement capacity, so from replacement value. So that rally in the most distressed part of the market, or the beta rally, is really the value-driven one. However, on the fundamental side, if you think about what drives markets, part of it is liquidity. And I think there is a realization that a number of large central banks in emerging markets will be perhaps more accommodative this year. So don't fight the central banks theme emerges, and that is positive for the markets that trade at some one standard deviation away from its historical mean. So it's a combination of liquidity and the cheapness of the markets. However, clearly we still have pretty large left tail risks that will remain with us for the coming year.
What's the worst case scenario that you're working with right now as far as the European situation is concerned in your allocations to emerging markets?
It is a risk that we have seen in 2008, and that is the seizure of capital markets. Again, with the introduction of LTRO facility and with European banks drawing on that facility, the probability of that accident has somewhat diminished. But we still see, clearly ample room for policy mistakes that could result in the seizure of the market. So for us, that would very much signal the seizure of the growth story for the immediate, and this is what the markets will very much not like.
Do you expect a Greece default? And if that does happen, how would that change the dynamics?
We expect Greece to either default or restructure. But again, as it pertains to EM markets, I think there are broader issues. Would Portugal need restructuring or additional funding? Would Europe fail to come up with a policy response that will be more long-term in nature? It is, again, I think that it is not the event risk, but rather the recipe for a structural gliding path that we need to see to become sanguine about the healing of the capital market.
How are you accounting for the volatility in emerging markets?
Sure. Well, we were big proponents of the tail risk hedging for the portfolios. We do think that in the environment where a lot depends on the healing of the market on the basis of the sovereign issues, number of currencies could be a good hedge. So we have a hedge of being short euros as a way of curtailing some of that volatility should that type of event occur, as well as a number of other instruments such as puts on a variety of markets. However, again, if you were to look at what outperforms in the longer term, actual low vol stocks tend to beat the market in the long term. So I think the two and two are not mutually exclusive. You could have a lower vol portfolio in stocks that produce income, that have growing income, that eventually beat the markets regardless of where you are in the cycle.
So as we start 2012, Masha, are you more confident about the way EM equities would pan out this year, or are you cautiously optimistic?
Probably the latter, given that we have that probability and I guess the worry about a left tail event being realized. However, what is on your side is value. The EM is trading at 1 standard deviation away. EM currencies have had a pretty big hit, or have taken a pretty big hit in 2011. So as you remember, the EM returns are composed of a third of a currency, 2/3 country and stock. So when you have taken the hit on the currency, you're more likely than not to perhaps have that as a tailwind in the coming year.
Masha, when we're discussing emerging market equities, after the fall or the disaster year that they've come out of, what is the return expectation that you have across the board on an average?
Well, if we have slowly healing markets, we will have markets in EM trading back to historical average. So that will give you on some 10-15% of capital appreciation. Plus, we see earnings growth on a secular basis for EM of some 10 to 12%. In addition to that, you're getting dividend yield of 3. So if you were to combine that together, you can get this year to some 25% return.
And that you're not accounting for the appreciation in EM currencies?
That is correct. So if we are not making a bet on currencies, that could be 25%. Now, we've done nearly half of that in the first couple of weeks of the year. So clearly, the realization of the thesis in the coming months will have to be accompanied by the thesis of healing markets. Now, as we discussed previously, the left tail risks are still omnipresent, and we will see buying opportunities, I'm sure, further down the road as some inevitable structural issues re-emerge, be that in Europe or in the United States.
Why is opinion on China changing so rapidly? I mean, we have a lot of funds going overweight on China. There is a sense that the risk regarding hard landing in the economy has abated. So perhaps there is an opportunity there to go long. But do you think that that risk was a bit overdone?
Well, there is a cyclical and structural reason, right? So the cyclical reason is that we are likely to see a pretty large step down in inflation, and that is a question of year-over-year effects when we will probably see a print of 3% this year in CPI versus 6% last year. So the end of political transition in China should untie the hands of the politicians and central bankers and see more liquidity being pumped through the system. Now, that does not clearly address a number of structural issues that the bears tend to bring forward. So cyclically, it's a good period because, again, you see the central banks injecting money in the economy. Valuations are not particularly demanding, but again, structurally, in order for you to buy and hold China on a 3 to 5 year basis, you will need to see structural reform taking place.
So, if we were just to step back and take a broad view of emerging markets, then which are the markets that you're bullish and bearish on right now?
So again, from the cyclical perspective, you would be bullish markets where you have combination of value and increase in liquidity. So China, Brazil will fall in that category, and perhaps more secure markets in perception of investors, i.e. low beta markets, Malaysia, Indonesia, etc., are the markets where returns have been very, very decent, where valuations are less stark, and hence the opportunity for excess returns may be less compelling or less enticing than in more pro-cyclical markets. Again, this is very much a trade that is geared on injection of liquidity. On a structural horizon, I think China does see a number of very serious issues that need to be addressed, whilst the Asian markets that may not fare well this year from a cyclical perspective have an ample room of benefiting in the way of returns from an investment-led growth.
Given your view on China and Brazil, do you expect a rally in commodities this year?
Well, we somewhat have seen the rebound from the lows. There are a number of important things that you need to remember for the context. One is that China, contrary to 2009, is unlikely to have a very, very strong investment-led boom. And that will curtail in the margin a demand for commodities. So I would be very surprised if we see copper and other commodities going back to previous highs. But clearly, given the 30+% adjustment from peak to trough, these commodities should see more incremental demand, and that could be reflected in prices. The second point is that not all commodities are born equal. So some more finished goods, such as, say, steel, cohabitate in a global environment. And if you were to look at European capacity utilization in the steel sector, that remains very low. So excess capacity will be found in markets elsewhere, putting pressure or putting the lead on the price.
What about sectors across emerging markets? Is there a broad theme? What's your approach? Is it more sector and then stocks, or is it a bottom-up approach across the market that you're bullish on?
Sure, it is a combination of the two. And I think today, uniquely, you can find a combination of yield, growth in earnings, and some beta. So you won't find that in consumer staples, that perhaps is a more overvalued area, but you can find that in scarce assets such as ports, such as potash. In other words, these are companies that are in somewhat cyclical area, but the earnings volatility is not tremendous, where you can find stocks yielding anywhere between 7 to 10%. And that's a pretty good underpin of value. So today we are more inclined to buy a number of industrial stocks, but industrial stocks that have that underpin of the yield. Certain select material stocks that are trading at very distressed valuations. Yet, obviously, we still have a very large portion of the portfolio allocated towards consistent earners. And these are companies that have low volatility of earnings, that trade at decent multiples, and that give you yield.
Corporate behavior that you spoke about, have you seen changes there in the quality of managements of companies that you deal with?
Well, crisis is obviously a very good thing for less mature companies. The reason for that is, these companies were endowed with a superb opportunity of a very strong top-line growth. So when the economic environment around you is stupendous, and when liquidity is readily available, corporate managements tend to go on a quest, egocentric quest of largesse. And clearly a year like 2011 tend to pare down the ambition. So what have we seen? We have seen a more prudent management of working capital. We have seen a scaling down of capital expenditure plans. And we have seen a number of stocks being clearly punished for growth that is not financed through internal organic cash flow generation. So this is a very good lesson to promoters to keep the ambition reined in, keep the ambition in check, and hopefully again that will translate into more prudent decision making in the coming years.
And pay dividends on time.
Correct.